want to bring up Connie Edwards, who is one of our Vice Presidents of Client Services, to introduce our next speaker. Connie?
Thank you, Daryl. Welcome back from lunch. I realize it was a quick lunch. Welcome back, our web audience. SB863 has brought several changes to the existing self-insurance laws of California, some of which are minor, and others have significant impact on self-insured employers. Changes have been made in many different areas. Our presenter in this session is Marilee Robinson, Supervising Workers' Compensation Compliance Officer with the Office of Self-Insurance Plans. She will address what, why, and the impact of the changes. Marilee has more than 30 years in the workers' compensation industry. She has served in her current position since 2004, and she has been with the Office of Self-Insurance Plans for 22 years. She holds her bachelor's degree in science in health from California State University, Long Beach. Please join me in welcoming Marilee.
Hello. Right now there are over 7,900 self-insured employers, which cover 4 million California workers in the event of an industrial accident or injury. And there are several areas of change, 3 particular, that have occurred due to SB 863. And the first is the calculation of the security deposit. Second is that specific employers will no longer be issued certificates to self-insure. And the third is that there are going to be reporting requirements for public self-insurers. And calculation of the security deposit. Labor Code Section 3701C has been changed to the following. Unless otherwise permitted by regulation, the deposit shall be an amount equal to the self-insurer's projected losses, net of specific excess insurance coverage, if any, and inclusive of incurred but not reported IBNR liabilities, allocated loss adjustment expense, and unallocated loss adjustment expense, calculated as of December 31st of each year. The calculation of projected losses and expenses shall be reflected in a written actuarial report that projects ultimate liabilities of the private self-insured employer at the expected actuarial confidence level to ensure that all claims and associated costs are recognized. The written actual report should be prepared by an actuary meeting the qualifications prescribed by the director in regulation. Now, I'm sure you're wondering why this is a huge change, and I'm sure you're wondering why. And the reason is that the actuarial method is a better predictor of exposure of liabilities over the entire portfolio of claims than what we're previously doing. And it is a true indicator of risk in the event that a self-insured defaults. And we've had the defaulting self-insured have been tremendously under-reserved. So there is no longer a minimum security deposit requirement. It's no longer 135% of your estimate of future liability as indicated on your annual report, with a minimum of $220,000. And your deposit may go up and it may go down. I've had several, not frequently, but every once in a while I come across an employer who has been using an actuary who tells me my reserves should be lowered because my actuarial says so. And so here we are, that might be true in your case. And it may not be. The actual report will be due after the March 1st annual report filing deadline, and the date will be determined by regulation. And another way of looking at the actuarial report situation is that you can probably find some ways to deal with your workers' compensation program better. It can highlight losses and possibly ways that you can correct some problems that you're having. Now, the actuary qualifications will be determined by regulations, but they are expected to be similar to the regulations for the actual requirement for the self-insurance groups, which is in Regulation Section 15481. Now, estimated future liability is still required as stated in the Regulation Section 15300, and those estimates will be considered in preparation of the actuarial report along with a lot of other information. Audits of private self-insured employers will continue on a 3-year basis in accordance with 3702.6, so you're not getting out of being audited. Estimates of future liability will be reviewed as listed on the last annual report, as well as record-keeping requirements and reporting requirements. And depending on the findings of the audit, another actuarial report may be necessary. We're determining the threshold of difference between the findings of the audit and what the actuarial report says, and it will be, the auditor is not going to be the person that determines if another actuarial report will be needed. We will be hiring additional staff in our office who will be able to make that determination. So specific employers will no longer be issued certificates of consent to self-insure. And this is a labor code section that was added. 3701.9A states that a certificate of consent to self-insured shall not be issued after January 1st, 2013 to any of the following. Number 1, a professional employer organization, otherwise known as a PEO. 2, a leasing employer as defined in Section 606.5 of the Unemployment Insurance Code. 3, a temporary service employer as defined in Section 606.5 of the Unemployment Insurance Code. 4, any employer, regardless of name or form of organization, which the director determines to be in the business of providing employees to other employers. And B, a certificate of consent to self-insure that has been issued to any employer described in above, subsection A, shall be revoked by the director not later than January 1st of 2015. And you're probably wondering why this occurred, and this a little bit was talked about this before, but this is a legislative mandate. It was not done by our office, but speculation from our office that it was done because we have had 2 PEOs that defaulted with significantly underfunded liability. And additionally, these types of businesses are different than self-insured employers, the usual self-insured employers, in that their number of employees go up and down. And the estimate of future liability and the injuries goes up and down. It's not constant as it is with most of the self-insured employers. So, reporting requirements for public self-insured employers. Labor Code Section 3702.2A has changed to the following. All self-insured employers shall file a self-insurer's annual report in a form prescribed by the director. Public self-insured employers shall provide detailed information as the director determines necessary to evaluate the costs of administration, workers' compensation benefit expenditures, and solvency and performance of the public self-insured employers' workers' compensation program on a schedule established by the director. The director may grant deferrals to public self-insured employers that are not yet capable of accurately reporting the information required, giving priority to bringing larger programs into compliance with a more detailed reporting. And we know that there already are public self-insureds that are keeping this information. And primarily what we're looking for is to establish best practices. Obviously, there's been 3 bankruptcies that we're very concerned about. We are starting to audit public self-insured employers. And that's pursuant to 15403A. And what we're looking for, of course, the most important thing is the solvency issue. That's primarily why we were asking for more information. And we are also looking to see if a public self-insured is under-reserved or if they are over-reserved. So, any of the changes that will be in regulation, and we're writing a lot of them, will be on our website, the Self-Insurance Plan's website. So does anyone have any questions?
If there's an audit of the annual report and the SIP decides that another actuarial report is needed, would it be an independent actuarial report or would it be an actuarial report from the same firm? any thought about whether,
Well, the firm has to fit the requirements.
right?
We haven't made a determination. I don't know if that'll be addressed in the regulations, but, the firm is going to have to fit stringent requirements. And we are still auditing when we are going to be continuing to audit using the random sample, like we have been in the last year.